It's Brian Preston, the Money Guy.
When it does come to investing, even though all investing has some sort of risk, you get to control where on the risk spectrum that you live. And we think that the first thing you have to understand when it comes to risk is the difference in risk tolerance and risk capacity.
Yeah, risk tolerance just means, are you a cowboy, cowgirl? You really, because there's a lot of people that have a lot of tolerance to ups and downs. We work with financial mutants all over the country.
Business owners.
And by the way, here's the thing. I work with some very successful people. We have to have a lot of discussions because they can be 70 years old, still ready to rip and go at it. Doesn't mean they should. Just because you can handle the risk tolerance doesn't mean you have the time for the market to recover. Because think about this. You're 70 years old, market loses 35, 40%. You're diversified like you're 25 instead of 70. It might take you realistically 7 to 10 years to fully recover. Your time horizon doesn't say that is appropriate.
If you're living off those assets,
from a risk capacity standpoint.
That's exactly right. You have to understand those two separate sides of the equation. How much can you handle, but also how much should you handle?
So that's why don't just assume because you like risk, you can handle risk, you'll be okay. Because that's why I see that all the time out there in a lot of case study. And that's why there's a difference between just building wealth and keeping wealth. If you don't have a healthy respect of fear of what you could be losing, you're probably doing it wrong.
So you can understand the differences in risk. The other thing that you can make sure you focus on is the appropriate mix of risk on and risk off assets. We see this all the time, that the way that you control the risk exposure is by the composition of your portfolio, and there should be an appropriate glide path for you. It's okay when you're young, when you're starting out, when you're in your 20s and 30s, if you have a really aggressive portfolio. Maybe it's more stocks and less bonds, or less risk-off assets. But as you move through time, and as you do get closer and closer to retirement, and as the portfolio does get bigger and bigger, you do want to make sure that you have that risk composition correct inside of your portfolio.
And then that leads to the last one, this one, I think not only in 2020, we've gotten the pandemic, we've got an election year.
Oh, yeah.
I mean, and we've done a show on how to election-proof your finances because I have so many people who I know in the community or have known at some point in my life reaching out and going, what are you doing about this election?
What should I do?
And by the way, it's not one-sided. It's so funny is that what one group is worried about this president, the other group is just as worried about this president. It's just such a bizarre time right now. And what I always ask them is this last component. I say, hey, over the next 2 years, do you have enough cash to cover any of the needs that might come your way? I'm not talking about you need to have 2 years worth of cash reserves. I'm saying for living expenses, I'm saying do you have 2 years worth of anything that could be coming your way you have covered, for emergencies and so forth. Now, look, if you're a retiree, maybe you will have 24 months of cash reserves, living expenses. But I'm thinking for the typical person that has a good job, you're in a good situation, you just need to be thinking about, do I have kids going to college next year? Do I have enough money in cash reserves so if the hot water heater breaks? Make sure you're thinking about all those things, and that's going to give you a lot more safety net to understand what you can and cannot handle emotionally.
When we work with clients who are easing into retirement or approaching that retirement date, one of the biggest fears they always have is, what happens if I retire at the worst time? What happens if I retire and 2008 happens? What happens if I retire and COVID happens? We say, well, if that happens, we've got your portfolio structured in such a way that you can weather that storm. And because we have been building up your cash, because you have that 12, 18, 24, 36 months of cash, you don't care if the market drops because you have enough time to let it come back. Because you've taken the appropriate risk measures, you've built your portfolio suitable to your stage of life, you can weather whatever storm the market throws at you.
Yeah, I always tell people, if you're in your 20s, 30s, and even 40s and the market gets beat up and you still have a good job, you ought to celebrate the volatility.
You'd be excited, yeah.
Because in the long term, it's not boring markets where you make a lot of money. It's actually the volatility if you're buying into it every month. And that's going back to the root discussion we were having. How do you be the best market timer? How do you be the best investor? Guys, have a plan.
That's it.
Have a process. No, it's your savings rate is going to be much more powerful than a lot of these other components that we're talking about. So if you're not putting enough respect into, am I saving for the future? Am I creating an automatic behavior that will put this money into play for the long term, so emotionally I'm not derailing myself? We've already heard about you can have analysis paralysis by not doing enough, or you can have overconfidence bias where you're actually doing too much. There's something right there in the middle, and that's that dollar cost averaging plan where every month you're doing the behavior that I think you'll find is your Goldilocks strategy that's going to get you through whatever comes your way.
If you want a little bit more, a little bit extra, you can go out to our website, moneyguy.com/resources. Out there we have deliverables, PDFs. Brian, you mentioned the 8 questions you can ask your advisor. These are all tools we want you to take and use. They are completely free. They're completely at your disposal because we want you to be the world's best investor. We want you to understand what and how to get to financial abundance. And we're so happy we get to be your co-pilots on this journey.
Hey, and FTE Daniel, well done on the case studies, brother. Bo and I was like, because we had somebody mention to us, hey, have y'all done a show on when you should invest, how you should do it, good times, bad times? It's like, of course we have.
Yeah, we have.
And when I pulled the data, we had no visuals because it was before we had Reeby and Daniel on the team. And I was like, oh my goodness, this show has got to get better right here, right now. So guys, share this friends, family, share it with anybody you think could benefit, because I think now that we've added the case studies that this team does so well that makes this world class, it's going to be great for you just to learn from this so you can learn and apply this in your own personal finances so you're insulated but also become more successful. I'm your host, Brian Preston. Money Guy team out.